Preparing for Export Development Canada interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Export Development Canada, and why do you want to work here? EDC helps Canadian companies compete internationally by providing financing, insurance, guarantees, and expertise where private markets may be limited. I am attracted to the combination of commercial discipline and economic impact. Strong risk decisions can help a Canadian exporter enter a new market, protect receivables, or expand production. My background in analysis and stakeholder communication fits that mission. I also value EDC's emphasis on integrity, sustainability, and responsible international trade, rather than viewing returns in isolation. While answering, focus on EDC's role as Canada's export credit agency, its financing and insurance solutions, support for Canadian companies, international mandate, and your connection to its public purpose, commercial, and values-driven environment. Question 2. How does EDC support Canadian exporters? EDC supports exporters across the trade cycle. It can provide loans or guarantees to improve access to capital, insure receivables against commercial or political risks, support contract bonds, and offer expertise in international markets. The appropriate solution depends on the company's customers, cash conversion cycle, balance sheet, and country exposure. For example, insurance can give an exporter confidence to extend credit, while a guarantee can help a commercial bank lend against an international contract. Make sure to cover EDC's major product areas, including direct financing, guarantees, trade credit insurance, political risk insurance, bonding support, equity solutions, and advisory expertise for different exporter needs. Question 3. What is the difference between EDC and a commercial bank? A commercial bank primarily allocates capital according to its own risk-return objectives and lending mandate. EDC has a broader public mandate to support Canadian trade and investment, particularly when market gaps exist, while still applying disciplined credit and risk management. EDC often complements banks through guarantees, co-lending, or insurance instead of displacing them. The key concept is additionality. EDC should enable a viable transaction that might otherwise be unavailable, insufficient, or too costly. In your answer, distinguish EDC's public mandate, risk appetite, additionality, export focus, and ability to complement rather than replace private sector financing, while acknowledging its need for sound commercial underwriting. Question 4. How would you assess the credit risk of a Canadian exporter seeking financing? I would begin with the borrower's business model and the specific source of repayment. Then I would analyze historical and projected revenue, margins, operating cash flow, liquidity, leverage, working capital, and debt service coverage. I would assess customer and country concentration, contract quality, management capability, collateral, and currency exposure. Finally, I would stress key assumptions, such as delayed customer payments or weaker demand, and recommend structure, covenants, pricing, and monitoring proportionate to the risk. Be sure to mention financial performance, liquidity, leverage, cash flow, customer concentration, industry conditions, management quality, transaction structure, collateral, country risk, and repayment capacity under downside scenarios. Question 5. What is additionality, and why is it important at EDC? Additionality means EDC's involvement creates financing or risk capacity that the market would not provide on reasonable terms by itself. It matters because EDC has a public mandate and should use its balance sheet where it adds measurable value. For example, a bank may understand an exporter but hesitate because of concentrated emerging market receivables. EDC insurance or a guarantee could unlock the facility, allowing the bank to participate while supporting Canadian trade without unnecessarily replacing private capital. Focus on the idea that EDC should address financing gaps or catalyze private capital, explain how additionality protects its mandate, and provide a practical example involving an exporter or underserved market. Question 6. How would you evaluate an exporter entering a high-risk emerging market? I would separate the company's fundamental credit risk from the market's political and transfer risks. I would review the buyer, contract enforceability, currency convertibility, sanctions exposure, government stability, regulatory restrictions, logistics, and payment behavior. I would test delayed payments, currency devaluation, import controls, and interruption scenarios. Mitigants could include confirmed letters of credit, shorter terms, guarantees, political risk insurance, local partners, and tighter monitoring. The decision should reflect both strategic opportunity and recoverability under stress. In your answer, discuss political and sovereign risk, convertibility, sanctions, local regulations, customer quality, payment terms, supply chains, insurance protection, scenario analysis, and risk mitigants. Question 7. Explain trade credit insurance and when an exporter might use it. Trade credit insurance protects an exporter when an approved customer fails to pay because of commercial or political events covered by the policy. I would first evaluate the buyer and request an appropriate credit limit, then understand waiting periods, exclusions, deductibles, reporting duties, and indemnity percentages. The benefit is broader than loss protection. Insured receivables can support confident sales growth and improve bank financing. Effective policy administration remains essential because late reporting or unauthorized exposure can jeopardize coverage. Make sure to explain insured receivables, commercial and political causes of non-payment, credit limits, policy terms, indemnity, exclusions, and how insurance can support safer sales and increased borrowing capacity. Question 8. How would you analyze a company's working capital needs? I would map the cash conversion cycle from purchasing inputs through production, shipment, invoicing, and collection. I would examine receivable days, inventory turns, payable terms, seasonality, customer concentration, and changes during growth periods. An exporter may need more working capital simply because international customers pay later while suppliers require cash upfront. I would distinguish that timing need from persistent losses or weak controls, then size a facility using realistic peak utilization and stress-tested collection assumptions. Discuss the cash conversion cycle, receivables, inventory, payables, export payment terms, seasonality, growth funding, customer concentration, and whether financing addresses a temporary timing gap or structural weakness. Question 9. What financial ratios would you prioritize in an EDC credit analysis? I would prioritize operating cash flow, debt service coverage, leverage, liquidity, and working capital efficiency. EBITDA margin and return measures help assess profitability, while receivable days and inventory turns reveal cash conversion quality. I would study trends, not just the latest year, and reconcile earnings with cash generation. Ratios must be benchmarked against the industry and business model. An asset-light exporter and a manufacturer can have very different healthy leverage levels. I would then connect metrics to repayment capacity. In your answer, cover liquidity, leverage, profitability, cash flow, coverage, working capital efficiency, and trend analysis, while explaining why ratios must be interpreted against industry, size, cycle, and business model context. Question 10. Tell me about a time you had to make a decision with incomplete information. In a previous analysis, management needed a recommendation before all customer data was available. I separated facts from assumptions, identified the variables most likely to change the outcome, and requested targeted information rather than delaying the entire process. I prepared a base case and downside case, clearly disclosed limitations, and recommended a temporary approval with specific monitoring triggers. After receiving the missing data, I updated the analysis and documented what changed. That approach balanced decisiveness with disciplined risk management. Be sure to present a clear situation, identify the missing information, explain how you prioritized critical facts, managed uncertainty, communicated assumptions, made the decision, and incorporated a follow-up review. Question 11. Describe a time you disagreed with a colleague or stakeholder. A colleague wanted to rely on a favorable forecast that I believed understated working capital needs. I avoided making the discussion personal and walked through the assumptions, historical collection patterns, and a downside case. I also asked what evidence would change my view. We agreed to revise the forecast, add a liquidity buffer, and monitor receivables monthly. The final recommendation was stronger because the challenge addressed a specific risk while preserving the relationship and keeping our shared objective visible. Focus on respectful challenge, evidence-based reasoning, listening, shared objectives, escalation when necessary, and a concrete outcome demonstrating that disagreement improved the decision or process. Question 12. How would you explain a complex financial risk to a non-financial client? I would start with the business consequence rather than the technical label. For example, instead of saying foreign exchange volatility threatens EBITDA, I would explain that a weaker foreign currency could reduce Canadian dollar cash receipts and make debt service harder. I would quantify a reasonable scenario, clarify the uncertainty, and outline options such as hedging, pricing adjustments, or shorter payment terms. I would invite questions and confirm understanding, because effective risk communication should support a decision, not display terminology. Mention plain language, business consequences, visual or numerical examples, confirmation of understanding, practical choices, and avoiding unnecessary jargon while retaining accuracy and transparency. Question 13. What role does sustainability play in EDC's mandate and decision-making? Sustainability should influence both whether EDC supports a transaction and how that support is structured and monitored. I would consider climate exposure, environmental impacts, labor and human rights practices, community effects, corruption risk, and the client's ability to manage these issues. Strong sustainability analysis can identify financial risks, such as stranded assets, regulatory costs, or reputational damage. It also supports responsible Canadian trade. I would document material findings, require mitigants, and escalate unresolved concerns rather than treating them as separate from credit. Discuss responsible business, environmental and social risk assessment, climate considerations, human rights, anti-corruption, Indigenous and community impacts, disclosure, and balancing trade support with long-term sustainability. Question 14. How would you identify and manage sanctions, anti-bribery, or financial crime risks? I would begin with complete know your customer diligence, including beneficial ownership, counterparties, jurisdictions, transaction purpose, and source of funds. I would screen relevant parties and look for red flags such as opaque intermediaries, unusual payment routes, government connections, inconsistent invoices, or pressure to bypass controls. Any concern would be documented and escalated to the appropriate compliance team before proceeding. I would never assume a strong commercial opportunity justifies an exception. Protecting EDC's integrity and legal standing is essential. Be sure to cover customer and counterparty due diligence, beneficial ownership, jurisdiction and transaction screening, red flags, escalation, documentation, controls, and the principle that commercial urgency never overrides compliance requirements. Question 15. What would you do if a client requested approval for a transaction that raised a compliance concern? I would not approve or dismiss the concern informally. I would pause the relevant step, preserve the supporting information, and clarify the facts with focused questions. Then I would consult compliance, legal, and the appropriate risk authority, following established escalation procedures. I would keep the client informed without making promises or revealing sensitive internal analysis. If the issue were resolved, I would document the rationale and conditions. If not, I would recommend declining or restructuring the transaction. In your answer, emphasize pausing the process, preserving evidence, asking focused questions, consulting compliance and legal specialists, avoiding promises, documenting decisions, and communicating professionally with the client. Question 16. How would you prioritize competing requests from internal and external stakeholders? I would rank requests by client or business impact, risk, regulatory urgency, deadline, and dependency on other work. A sanctions issue or time-sensitive credit decision would generally outrank a routine reporting request. I would confirm expectations, communicate realistic timelines, and identify what can be delegated or simplified. If priorities conflict, I would present the trade-offs to my manager rather than silently missing commitments. My objective is reliable delivery without allowing urgency to compromise analytical quality or control standards. Talk about urgency, client impact, risk, deadlines, dependencies, regulatory obligations, transparent communication, workload planning, and escalating conflicts when priorities cannot be reconciled independently. Question 17. Describe a process improvement you would bring to an EDC team. I would first map the process, measure where time and errors occur, and distinguish unnecessary repetition from required controls. For example, if credit files repeatedly return for missing information, I would create a standardized intake checklist, clarify ownership, and automate simple completeness checks. I would pilot the change with users, track turnaround time and rework, and adjust based on feedback. The goal is not automation for its own sake, it is faster, more consistent decisions with an auditable control environment. Provide a practical example involving process mapping, root cause analysis, automation or standardization, control design, measurable benefits, stakeholder adoption, and post-implementation monitoring. Question 18. How would you approach an exporter experiencing financial distress? I would act early by reviewing liquidity, covenant compliance, overdue receivables, order quality, cash forecasts, and management's response. I would determine whether the problem is temporary, such as delayed customer collections, or structural, such as unprofitable contracts. I would engage the client and relevant lenders, build downside scenarios, and assess options including revised terms, additional security, asset sales, or operational changes. Any accommodation should be conditional, documented, and tied to a credible recovery plan rather than simply postponing recognition of risk. Focus on early warning indicators, liquidity runway, immediate cash needs, stakeholder communication, viability, restructuring options, collateral, covenant position, scenario analysis, and protecting recovery while supporting feasible solutions. Question 19. What would you do if your analysis suggested a different conclusion from your manager's view? I would first recheck my calculations, sources, and interpretation to ensure the disagreement was substantive. I would then ask my manager to explain the assumptions driving the different view and present my evidence, including sensitivity analysis and the potential consequences of each approach. I would remain open to information I had missed, while clearly documenting material risks. If the issue involved a policy, control, or ethical concern, I would use the appropriate escalation channel. Healthy challenge should improve judgment, not become a contest. Mention checking calculations, understanding the manager's assumptions, presenting evidence and sensitivities respectfully, remaining open to new information, documenting material judgment, and escalating only when necessary. Question 20. What questions would you ask us at the end of an EDC interview? I would ask how this team measures success beyond financial results, which exporter or portfolio challenges are currently most important, and how risk, sustainability, and commercial teams collaborate on decisions. I would also ask what distinguishes strong performers during their first year and how managers support development. Finally, I might ask how the team sees EDC's role evolving as Canadian companies face geopolitical, supply chain, and climate-related uncertainty. Those questions show preparation while helping me understand the role's real expectations. Be sure to ask thoughtful questions about team priorities, success measures, client impact, risk culture, development, collaboration, and current challenges, avoiding questions answered easily by EDC's public materials. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.